Okay, what are you saying, people, and welcome back to your favorite YouTube channel. So today, guys, we'll be talking about entries, specifically where to enter, where to buy, where to sell. If you're looking for a video more about confirmation and triggers to entry to actually enter the market, I do have a video specifically for that. Links in the description, so make sure you go and check that out. But if you're looking for a video more about where to enter, this is your video. We'll be using high time frame candlestick wicks to pinpoint our areas to make sure we're getting in at the right places. This is a very powerful entry strategy. So guys, without further ado, let's get straight into the video.
Okay, people, so welcome to the chart. So on my screen right now, I've got AUD, CHF, Aussie, Swiss franc on the weekly time frame. I'm just going to talk you through how we can use higher time frame wicks to locate the best places to enter the market and also locate the worst places to enter the market depending on our bias, basically not to enter at those zones. So yeah, on our screen right now I've got AUD on the weekly time frame, which is mainly the time frame I use this entry technique. You can use it in all time frames, but I say the higher time frames are the better ones to use it on because the low time frames are a bit more speculative and there's a lot more fluctuations. I really wouldn't use this any lower than the daily or the 4H really, but weekly does work very well. So on your screen, as you can see, we've got a big pile of wicks into this area, and all we're looking for is at least 3 wicks into roughly the same area to show rejection on the weekly time frame or what time frame you're looking on. So for example, here you can see there's many wicks here, but our first kind of area where the first time we're actually focusing on this area is after that 3rd wick placement. So as you can see here, big wick 1, big wick 2, big wick 3. So this is now clearly an area which the market on the weekly time frame is struggling to close at, struggling to push through, and now we're seeing rejection. So the technique, the theory behind it is that the next time we do come back into the zone, so potentially the next candle, we most likely by the end of the week, end of the candle closure, will produce another wick and fail to close in that level. And that level there, that big zone that I've highlighted with this yellow box here, is where we're going to be placing our short entries. If you've got a short bias, again, that will come from your strategy and the way you analyze the market. But if you're wanting to know where to place your entries and not enter the market too early, in this box here is where we want to be looking for our entries. So now you can scale it down to your lower time frames, whatever time frame you look to enter on. I'm going to be using 4H for this. And now we can look for the best place to enter our trades, which is in this area. As you can see, we've got 1, 2, 3 attempts at these highs up here. So from a 4H point of view, I'm going to wait for price to come all the way up to this area because that's what makes sense for a trade. Technically speaking, the market can pull back anywhere within here and then sell off, but we want to be making sure we're actually taking trades of local support and resistance on the time frame that we're trading to make it make complete sense. So if I just play this forward, all we're waiting for is price to come back into that zone and specifically back into our price up there. So as you can see up there, again, depending on your entry strategy, you can enter the market, stop loss above the zone, and again, looking to sell the market. And again, your targets can be using the same technique as well. So if I was to go back to the weekly time frame real quick, you can see here, there's a big pile of wicks around here. There's some wicks down here as well. You know, that could be your targets, or depending on your strategy as well. And if I just press play, you can see a lovely trade that played out, and we're getting right at the top of the market there. So we're not really worried about what the market's doing here because we're at support. You know, these are where wicks have collected on the weekly time frame prior to that. So we don't really want to be entering any sell positions at that area. If you're bullish, this is where you want to be buying the market. So once we see this move to the upside, we'll get ready to sell because we're in our wick zone. Obviously, price could break through and have a breakout. That's a different scenario. But if we do reject these areas, we're anticipating the market to pull back and by the end of the week, give us another wick into that zone. So if I go back onto the weekly time frame, you can see it again, by the end of that week, we pull back another wick into that area. And again, as long as the market is keep producing wicks into this area, that zone is still a valid sell. It's not like, okay, we've done it a 4th time, not going to do it anymore. If it keeps placing wicks into that area, it's still valid until price actually breaks that level. So again, coming into the following week, we're looking to see, because again, we're still placing wicks into the zone, we're looking to see if we can come back up into there and get another sell opportunity. And again, this is more like a range here, so chances are we're going to reject it anyway. But again, our resistance is formed up there, so we're not going to really look for any entries until we get right to the top. Reason being, we want to be entering off local 4H support and resistance, not just in the middle of nowhere on the 4H time frame. So in this case scenario, we didn't get up to that level, so I wouldn't have looked to enter the chart, because if I did enter and trade failed, you know, a stop loss would be above my entry candle, and I would be suffering price coming up, taking me out just to roll over. So that's not a trade for us there. Of course, you can take that trade, but it's just slightly more riskier. And again, let's go back to the weekly time frame to see if we're still placing wicks. As you can see, we are still placing wicks into this zone. So again, still valid. If we do come back up again, going to be looking for some sell opportunities. So now that we created this area of resistance here as well, that will become a valid place to look to sell. And then we've obviously got the level up there as well, which is all of these areas here are rejecting this level. And now we've got two areas to look at. So either we'll take a sell if we come up to here, reject it, then we'll look to sell. Or if we break through that area, we'll look for sell slightly higher up at a second area of interest, and then look to sell it back down. So let's press play and see how price plays out. Okay, so we're pushing up. So into this area here, we're slightly breaking above that level, but if we can close back below, we'll still look to take that trade unless we push up into our zone up there. Okay, that's a nice little entry there. As you can see, nice strong closure at that level, stop loss above. If that does fail, we'll look to enter at our second area up there. And again, targets for this one, depending where you want to place the trade, obviously you can use a strategy for that, but we'll just look for this area down here because this is where all the wicks are collecting on the higher time frame. Press play. As you can see, it does play out pretty well. And then as you can see, nice rejection there of that wick zone on the weekly time frame where wicks are collected. And then you can place a buy trade there to go back up if you're bullish, of course. And you can see price comes back up again, respects the area, and then absolutely dumps to the downside. So again, this is a great place to be entering your sell opportunities if you are bearish in this market, and if you're bullish, obviously down here. This is very, very effective because it allows us not to jump into trades too early, because for example, there will be a lot of people selling here, a lot of people selling there, a lot of people selling here, when in all fact the best sells were always up here to begin with. And now we've got that knowledge and that perspective, you know, we can just wait for the market to get to our area and not waste our time in these areas, set alerts, or just, you know, check the market every so often until we get to that area. And then you can look for your sell opportunities, and your entries are so much better because by the end of the week you're entering on that wick there. So if the market does reverse, you know, you're entering near the top of the reversal. And of course, if you held it, obviously that would be up to your strategy. You know, you would have a very, very good entry to see that trend through. And again, this works all the time, but you do want to be seeing price giving you those at least three good powerful wicks into this same similar area to be using it. Again, this is not a full out and out strategy, but it's a good strategy for entries, and make sure you're entering at the right places. You can see there's another example here. And also this is good because it allows us not to get faked out, because you can see here, this is resistance on the weekly time frame. A lot of people in the smaller time frames are buying at the highs up here because they're anticipating the breakout. But by the end of the week, all we do is get another wick and the market came straight back down. So to get that breakout, all we have to wait for is a strong close on the weekly time frame, or the time frame you're using the strategy on to classify the breakout. Because once we've got the close above, that shows that from a weekly perspective, we're breaking through the zone. It's no longer valid as a sell zone. Then we can look for a retest on the lower time frames and buy it back up. Here's a good example here. So all these wicks show rejection. We can look to sell pretty much all of those wicks there if you get a valid entry signal. Closing above, that shows us that price is actually trying to go bullish now, breaking above that zone. So if you see a retest, we can look for our buys to go back up. Again, drop to your entry time frame. Nice pullback to the downside there. Really nice entry in that 4H candle closure. Again, it doesn't have to be 4H, whatever time frame you use to enter your trades at. And again, targets wherever you're looking to push the trade to. Again, I'll do videos specifically for targets as well in another video specifically, but this is just for entries. So again, really nice entry there, stop loss below the zone, take advantage of that breakout. And this time you're actually catching the breakout. There's a lot of people here just buying at the highs and obviously getting faked out as the market comes lower. So we're getting those pristine entries. So yeah, guys, I hope this strategy technique has helped you. Again, look to go and back test that, see if you can get some good results from it, from your own trading, and not just dive straight into it. Make sure you get some practice in. And again, the important thing is that not all wicks are valid. You want to be using exaggerated wicks, at least 3, not 1 or 2, because that's not really showing too much significance. When you're getting 3 or 4 or 5, that shows real significance in that area. And obviously this shows you a great place not to be buying the market. As you can see on the weekly time frame, a lot of these wicks, you don't want to be buying the market down there, up there, sorry. You want to be buying the market down here at these areas. That gives you some really nice places to buy. Obviously that was a bit of a fake out there to the downside, but as we test it again, these are the places to buy, and obviously these are the places to sell. So it kind of helps you in that perspective of you're not going to miss out on a trade. If you're looking to sell the market and the market's trading at these prices, don't worry about it. Wait for price to pull back up. Great entry to sell it back down again. If you're looking to buy the market and the market's all way up here, don't worry about it. Wait for it to pull back and then get your entries to go back up again. So it allows you to pinpoint and avoid bad entries and make sure you're getting the better ones. But yeah, guys, I hope you have found this useful. If you have any more questions about this technique, something you didn't understand and explain something properly, let me know in the comments and I will get back to you. If you want to see more videos like this, let me know in the comments as well, and I'll make sure I'll get those videos out. But yeah, guys, I hope you have enjoyed it, found it useful. If you have, leave a like, subscribe, share, hit the bell so you don't miss any uploads in the future. Do really appreciate all of that. But guys, have a great day and I'll catch you all in the next one.